Just quickly on what we're covering today. I've been told this is a more advanced crowd, so we'll be diving into one step higher than your usual personal finance seminar, and we'll be diving into something a little sexier, which is alternative assets and how they might fit in your portfolio. Great. Okay. So alternative assets. So today we'll cover the whats, the whys. We'll dive into some of the most common ones, and then we'll help you figure out what you should be investing in and how it might fit in your portfolios. Great. Okay, to start off with, why even have this session, right? And if you look at today's investment landscape, it's all about access, access, access. Democratizing every sort of asset class, reducing ticket sizes to sizes that were only accessible otherwise to HNIs, and also the entire process of purchasing is becoming digitized. And all things equal, this is great, right? Everyone should have access to the asset classes that were reserved for HNIs or institutions, but as long as education keeps up with that access. And that's part of what today's session is about. So to start off with, and folks just drop it in the chat if I'm going too slow or too quickly. But to start off with, what are alternative assets? All right. So let's start with traditional assets. Traditional assets are anything that includes stocks, bonds, or cash. Alternatives are anything that's not traditional. So that includes private equity, venture capital, all the fancy risky stuff. All right. You'll notice that real estate and commodities, so gold, are also considered alternatives. But because they make up such a big chunk of Indian portfolios already, and because we understand them, we'll leave them out of today's discussions and we'll cover everything else. Before we dive in to individual alternative assets, let's cover why, right? Why should we invest in alternative assets? So to start off with, they help your portfolio in diversification. And they do that because they're uncorrelated to the broader market. And what that means is if you're invested in the Nifty, and the Nifty tends to go up and down, alternative assets don't move in tandem with the Nifty. So it gives you some protection when markets are in a downturn. Alternatives are also a great way to enhance your returns, right? Some of them have much higher risk reward profiles than your traditional FDs or bonds or even stocks. So if you are risk seeking, it's a good way to get that risk and that return. And what are some of the things that you should be thinking about before investing in alternatives? Well, one of the biggest ones is they have different liquidity profiles. And liquidity, and we'll cover this later, means how easy it is to buy or sell something. You're used to cash, you're used to stocks, you're used to mutual funds, which you can buy and sell easily every day. That might not be the case with some of the other assets you invest in. Return profiles tend to be asymmetric. And that means it's either super high or a zero, which is less stable than we might be used to. They also tend to be volatile. New access to asset classes means there are a lot of unproven models out there that might be risky to invest in. Alternatives tend to be more difficult to evaluate because there's less data around them. And they also tend to be unregulated or have lighter regulations because they're newer and the regulating body hasn't caught up with that yet. So there's no one to cry to if you lose your money, essentially. Okay, I'm sure you've all seen this chart many, many times in personal finance presentations, on fintech websites, and just shows the basics, right? The higher you go on the risk curve, the greater return you can expect. But part of what we're doing in today's session is helping you evaluate where each of these alternative asset classes lie on this chart and evaluating them in general. Sorry, folks, can you just make sure you're all muted? Thank you. Great. So, like I said, part of today's session is to help everyone on this call evaluate alternatives better. And to do that, we're going to introduce one additional metric to your usual risk and reward, and that's liquidity. And liquidity literally just means how easy it is to buy or sell something. If you invest in something, how quickly can you get out of it? With a bank account, you can put something in one day and you can pull it out the same day. With stocks, similar. With mutual funds, it takes 2 or 3 days. And with bonds, 2-3 days, maybe a little more. right? So how do the other asset classes look in the context of this this rubric that we've just set up, this framework? Great. Now that we've set up that context, let's dive in. To start off with, let's start with private equity. So private equity just means investing in unlisted companies. Listed stocks are called public equities. Unlisted companies are called private equity, right? There's two ways you can do this. There's two ways you can invest in private companies. And right now I'm referring to private equity refers to investing in later stage private companies that have proven business models, that have revenues. When you do the same thing with startups, it's called venture capital, and we'll cover that later, right? So private equity is later stage private investing. There's two ways to do this, really. One is you do it yourself, and there are several platforms now online that help you invest in private companies. Like you can invest in Chennai Super Kings or Five Star Finance before IPOs, and you can do that relatively easily and online, and as small as with a ticket as small as 10K, right? But you have to pick which companies might do well based on limited data. So that's one path. And the other path is you go the managed route, right? You let a professional decide, and there's regulated structures with which to do this, and they're called private equity firms like KKR. You might have heard of KKR or Carlyle. These are big private equity companies that invest in these companies. The pros of this is obviously you have a well-paid professional doing this for you full time, and it's a diversified portfolio approach. The con is there's a minimum ticket of 1 CR. So you have to have a portfolio above 5 CR to actually get access to this. Okay, so private equity for slightly larger amount of risk, and you can see that in this table here, and lower liquidity than stocks actually gives you the opportunity to get higher returns in the long term. However, a few things you have to think about while investing in private companies. Number one, you have to think about whether you actually have enough information to evaluate individual private companies, because the data available is so much less than a stock. So it's like investing in individual stocks, which is already hard, but one level harder. So can I do this, right? The second and probably the most important consideration to make when investing in private companies is, can I say goodbye to this amount of money for up to 10 years? Because that's how long it usually takes for your investment to materialize. It's not like a stock where you can just buy it and sell it the next day. So keep that in mind. Can I, the two things, can I evaluate this company with limited data? And can I keep this money locked up for about 7 to 10 years? And if you can do those two things successfully and consistently, you can make a handsome return, right? Okay, so that was private equity. Venture capital is just private equity, but with startups, right? When an individual invests in early stage startups, it's called angel investing. When a fund does it, it's called venture capital. It's that simple. Again, multiple ways to do this. There are actually 3 broad ways to do this with venture capital or with startup investing. Just like private equity companies, there are venture capital companies. So you can do it, go the managed route, where a professional does it for you with a high minimum ticket. There's a medium tier here with venture capital. And that's the filtered path. And what I mean filtered is there's an aggregator or an intermediary that sits in the middle, and they go through all the deal flow and they filter out the best deals for you. So then you can co-invest with them. Good examples are AngelList syndicates, Let's Venture, online angel platforms. And this is good if you are earlier to angel investing and don't even know where to begin, right? And then there's self-directed. So increasingly, there are a lot of platforms like now that are coming online that allow startups to list, and then you invest in them at your own risk with tickets as small as 10,000 rupees. So pros and cons to each of these levels of investing in venture capital. I think before we go to the risk reward though, the one thing or one of the most important things to keep in mind specifically with venture capital is your returns are almost entirely determined by the quality of the deal flow you get. What that means is the best investors see the best companies first, and they're able to invest in them early, and that's how they make the best returns. So more often than not, the best angels and the best VC firms that's up here see the best returns, best companies, and then that floats down in slightly lesser and slightly lesser. So the thing you need to keep in mind first and foremost, if you're doing this by yourself, is, am I actually seeing decent deal flow? Because in angel investing, the difference between good deal flow and decent deal flow is a sixer or a zero, right? That's just how the returns work in venture capital and angel investing. Great. So where does VC fit? The return profile for venture capital looks a lot like private equity, right? High risk, high reward, low liquidity. But I would say even higher risk and even more asymmetric returns. What does that mean? That means you're either investing something that's going to 10x or 100x, or it's going to zero. Okay. Things to keep in mind. Ballpark, in every portfolio of 20 companies, it's usually one that does amazing and everything else that does okay or zero. So when you're investing in venture capital or when you're investing in startups, one of the things you have to make sure is that you're able to invest in at least 20 companies. All right. Second thing you have to make sure. So invest in at least 20 companies. Am I getting good deal flow? And like private equity, can I keep my money locked up for 10 years? Because that's how long it's going to take for you to see an exit. Okay. Next up, commercial real estate. All right. Commercial real estate essentially means investing or buying a piece of an office building so that you can make rent monthly and then eventually make a capital gain when you sell that 5 years down the road. So with commercial real estate, with residential real estate, it's homes. With commercial real estate, it's office buildings. You're buying a piece of a building, you're renting it out to some big company, you're making rent every month and every year, and then you're eventually selling it and making a return as well. Again, two ways to do this. You can go via fractional commercial real estate platforms, companies like HBits, like Strata. They let you buy small pieces of buildings as small as 5 lakhs, and then get the returns from the rent. And they also enable you to get the returns from the capital gains by selling them 5 years down the road, right? The other slightly safer, easier path is going through a REIT. A REIT is basically an ETF for buildings. You can buy it and sell it on Zerodha or Grow. You can buy it on a stock exchange, super high liquidity, small ticket sizes, and they're diversified. So you're investing in a bunch of buildings instead of just one. And in exchange for that diversification, exchange for that liquidity, you're getting a lower return, right? These are the only ways to do it outside of buying a whole building yourself, which will cost you, 100 crore plus. So that's why there's value in these paths to commercial real estate investing. Okay, here we are with commercial real estate, and here's where it fits. The main thing to think about first and foremost when you invest in commercial real estate is, do I need fixed income or do I need income for my portfolio as opposed to just wealth creation? Because commercial real estates are a great higher yielding alternative to FDs and bonds with a little more risk and a longer lock-in. So think about that. Do I need fixed income in my portfolio? If so, commercial real estate could be a good option, especially fractionalized. Number two, like PE and VC, you really have to think about whether you can keep your money locked up for at least 5 years, because that's how long it takes to get your money back usually, because someone has to find a new buyer for your building or the piece of the building that you've invested in. So keep that in mind. And lastly, do you trust the platform to find the right buildings for you? Keep in mind, the platform that you're going and buying this from is going to the buildings, sourcing them, looking at if the tenant's going to keep paying for 5 years, and then eventually has to find a buyer for the building. So make sure you keep those things in mind. Do I need fixed income? Do I have a 5-year time horizon? Do I trust the platform through which I'm going? And will there be a tenant for 5 years? Think of this as a higher yielding alternative to FDs and bonds. Okay. Next is a broad category called fixed income alternative assets. And we're not going to dive into each of them, but fixed income is exactly what it sounds like, right? You invest or lend money to someone and they pay you a fixed income on it every month. Sorry, I think someone dropped something in the chat in case. Great. There are several types of, so just to get that again. Fixed income is when you invest in an asset or when you lend money to a company, and in return, in exchange for that loan, they pay you a fixed income every year, and they eventually return that money back to you in, say, 5 years. That's what fixed income is like. So all your bonds, your government bonds, your corporate bonds, those are all fixed income products. Now, there are many companies and startups popping up that offer you different other alternatives to fixed income products with higher returns. So some type of fixed income products are revenue-based financing, invoice discounting, lease financing, P2P lending. These are all different types of fixed income products. And we're not going to dive into each of them individually because they offer a whole range of risks and reward. So instead, we'll talk about general themes you should think about when investing in fixed income alternatives. But take this with a grain of salt. Fixed income alternatives probably lie somewhere closer to CRE in terms of the type of returns you can generate and the type of risk you're taking. But in general, things to think about when investing in fixed income alternatives, okay? Don't just get drawn to yield. You really need to understand where that yield or the return or the IRR is coming from. Truly understand the type of asset you're trying to invest in, number one. Number two, try and understand whether it's secured. Is there an asset on the other side? And who is guaranteeing the collections on this, right? So for example, in a lot of P2P lending companies allow you to lend to an individual person, but then don't help with the collections. So very hard for you to actually get a return on your assets. So make sure you know what you're investing in. Don't just follow yield or IRR. Make sure you understand the asset. Make sure you know who's guaranteeing it and whether it's collateralized. Just things to keep in mind. But like commercial real estate, if you find a platform you trust and you find an asset you understand, great alternative to FDs with higher returns. Okay. And probably the most controversial, but no discussion on alternatives, in my opinion, would be complete without discussing cryptocurrencies, right? Or crypto in general. So cryptocurrencies originally, or crypto originally, just referred to a digital currency that is A, decentralized, and B, secured by cryptography. Decentralized just means it's not controlled by one central person or institution, like a bank or government. And cryptography is just a fancy way of saying secured by code, like codes. So that was what cryptocurrency originally meant. Crypto has now more generally become an umbrella term for everything you're seeing on the screen right now, right? Bitcoin, Ethereum, tokens, Metaverse, DeFi, NFTs, all refer to versions of crypto. Look, I say crypto is controversial because some people have made a lot of money and a lot of people have lost a lot of money on crypto. And today's session is absolutely not about whether crypto is good or bad, whether it's evil or not evil, whether you should, have it or not. Today's session is just to talk about how you should evaluate crypto and what you should think about if you are considering putting it in your portfolio. That is all. Everyone's entitled to their own opinion. And people feel strongly about crypto, one way or the other. So where does crypto fit? First of all, with crypto, even if you believe in it strongly, only invest as much as you're willing to see go to zero. It is an unproven asset class. It's an asymmetric bet. It could go really well, or it could probably go to zero or very close to zero. And we've seen that happen with multiple assets. If you do want to venture in there, like I said, beyond just investing only as much as you're willing to see go to zero, try and stick to the bigger projects and bigger coins like Bitcoin and Ethereum. The further down you go into different types of tokens and different types of projects, the more you should understand about them before investing. There have been a lot of success stories, but those have some survivorship bias. Please don't bet the entire house hoping you'll find the next Dogecoin before it's Dogecoin or the next Ethereum before it's Ethereum, unless you understand it. No, it's not a lottery ticket. Where does crypto lie? On the risk spectrum, certainly at the top. On the reward spectrum, it has shown some great returns. How it will play out in the long run, yet to be discovered, right? There's no cash flows backing crypto tokens for the most part. It's based on, it's essentially an asymmetric bet, which could go either way. You'll notice I have liquidity as a question mark. I only say that because theoretically crypto tokens trade on an exchange, so it should be really easy to buy and sell them like stocks. But as we've seen before, just because there's an exchange doesn't mean that exchange will remain solvent enough or alive enough, or even let you take your coins out once you bought them. We've seen that in India. We've seen that with exchanges in India. We've seen that with FTX, most recently globally. So keep in mind that even if you get in, you may not necessarily be able to get out. Okay, great. We're good on time. We've covered, we've quickly covered the different types of alternative asset classes. And now time to dive into how to construct your portfolio with alternative assets, right? And it's a difficult question to answer, just like portfolio construction with traditional assets, because it's so subjective. So instead, I'll cover things to think about. I'll cover thumb rules, and then I'll walk you through my personal asset allocation and how I think about it, so you can use that as an example. But number one, always start off with what your investing objective is. Are you doing this? Are you investing because you need an income from your portfolio? Are you investing because you want to create wealth in the very long term? Are you investing for some educational purposes or stimulation? You just enjoy it. Are you investing to give back? For example, some people angel invest to give back to the startup community, much more so than trying to get a return. Second, what is my risk appetite? Because as you've seen on our favorite table here, your risk appetite will materially define what you should and shouldn't invest in. How long can I afford to keep this money locked up? Different profiles based on 1 year, 3 year, 5 year, 10 years, and 20. And then finally, do I understand this asset class? Even if I do understand it at some level, am I really equipped enough, and do I really have enough data to pick individual assets, or should I just use a manager? And even if I am equipped and I do understand it, do I actually have the time to do this well, or am I better off investing in traditional assets that still give me a great long-term return? Okay, what are some rules of thumb? Please take these with a grain of salt. This is not financial advice. This is just based on what I've seen with most other high-risk family offices. Most of them target, 20 to 25% in alternative assets. Most of that 20 to 25% tends to be in managed venture capital and private equity. Those are the main alternative assets. There tends to be some in private credit, which is investing in bonds too. But 60 to 70% still goes into just traditional equities via mutual funds or PMSs and stocks. Fixed income alternatives are still new. They haven't been stress tested. So larger offices don't really put them in their portfolios as much yet. And crypto, based on surveys, the sense tends to be low single-digit percent, so 1 to 3 to 5% of your portfolio. But again, with crypto, it really comes down to how much am I willing to go to zero? That's how you should think about it, truly. And as promised, here's a high-level snapshot of my asset allocation. These are the details on the left, and this is just consolidated in the different types of high-level asset classes, okay? I am young-ish, or I like to think I'm young. I'm 30. I have a high risk appetite. I'd say very high. I'm lucky that I have no fixed income needs from my portfolio. My income takes care of all my income needs. My portfolio is purely for long-term wealth creation. I have a very long timeline and no immediate goals for, a big purchase like a house or a wedding. So this is all just to create wealth in the long term. And you can see my assets reflect that, right? I have almost 65% just in Indian equities through a mix of mutual funds and PMS and direct stocks. This 7.5% here should say direct stocks. I'm sorry. And you can see I have a preference for managed stuff, right? I run my own startup, with our team runs our own startup, and I don't have the time to be stock picking all the time. So I keep most of my funds managed. Similarly, in alternative assets, I try to go the managed path. I have a small foreign exposure, and then I'm not sure why it's reflecting, but this small piece of the pie is 3%, 2 to 3% in crypto exposure. So just going to leave this up. Like I said, 65% in Indian equities, 7.5% in US equities. These foreign equities, almost all US. 18% in alternatives, so close to that 20% mark. 3% of that is crypto, and 7.5% each in private equity and venture capital. And then I have some cash lying idle to just take advantage of market moves as they come and go. And I like to keep that 10-15% buffer usually. Great. And that's it. That covers the presentation part. Thank you folks for listening.